Welcome to our start of the week. Weird sort of moves. Just before we started this session, Adrian said, "What's the FTSE due?" And I looked at it. I thought, "My God, we're due sort of 45, 50 lower." And I thought, "I can't be right." I have to say the FTSE does trade in it rows its own boat, really. We had the quarterly expiries last Friday, as all of you know. Hi, Steve. Hi, John. And you do get a bit of sort of volatility in that, and I know the market came off quite sharply after the expiry. But to see it due another 50 lower this morning was weird. David, morning to you. Good morning. So, FTSE. Well, the FTSE was only 13 down. That's sort of nearer where I thought it would be, actually. We had the a rebound in the euro. I don't know whether anyone heard the news over the weekend. I think there was a slight spat between Chancellor Angela Merkel and François Hollande, President of France. They clashed over the weekend on a timetable for starting the oversight of the banking sector in Europe, and I think it just underlines the sort of tensions that exist there. And there's also some news about China as well. But anyway, let's go to our bit here, because I know Adrian has a lot more stuff to talk to you about. We are just going to look at the calendar first of all. If we click on Trend Signal, click on Free Trading Tools, and then down here, just launch the economic calendar. Whilst I'm doing that, let's just have a quick review of what happened last week, just before we launch into everything else. On the markets, FTSE was, well, you can see there, it's a daily chart on the FTSE. FTSE was down just over 60 points, it's about 1%. Gold, unchanged, hugely volatile on Friday. Charlie, I heard you talking about gold. It is largely moved by the US dollar, obviously being priced in dollars. That does affect it quite dramatically. And also, obviously, this QE was a little bit sort of disappointing, really. I think the market was expecting perhaps some slightly more aggressive tone from the US, but it certainly had not had the desired effect on crude, though, because crude oil was a big move last week. I think we were down, I don't know, who trades gold here? I think it's about $6 in the end, if you have a look at US oil. Yeah, so we had a sharp reversal there. So all you crude traders, you got on that one. I think the bottom of the envelope in this pivot around the sort of 91.80. This is on WTI, by the way, and that sort of held it. But that's a 6% move. Do you remember we were talking last Thursday about commodity moves? And this is the reason why you've really got to watch your stake size when trading commodities, because in percentage terms, they really can be exceptionally volatile. And crude oil is very, very widely traded, like gold, and you do get some extraordinary moves, like silver, like the soft commodities. You get some big moves. So when you're trading those, the analysis is obviously the same, but just remember the scale of moves that you can witness. Okay, let's go back to our calendar. So last week, I guess we could put this down to profit taking on the risk-on trade. Risk-on sort of following all this sort of central bank intervention in the form of the bond buying program in the EU, the ratification by this constitutional court in Germany, and then the modified QE in the US. That's all sort of been fairly positive to the markets the previous week. But last week, as we said this time last week on our Monday show, that following a sort of sharp run-up that we'd seen the previous week, that we were going to get some backing and filling. I talk about on the charts where the market has run up so quickly, the market needs to digest that sort of a move, and you tend to get spats of profit-taking, etc., which is sort of referred to as backing and filling. So the trend is not necessarily changing, but just profit-taking. Mike, silver is a bit less aggressive, though, isn't it, in terms of swift moves? Mike, silver can be extraordinarily volatile, surprisingly. I don't know whether I've got it on here. It's XAG. Yeah, I have. You look at this sort of a move, Mike. Look at quite a bit of a setback already this morning. Extraordinary run up following this break of this key pivot here, and I remember that back at the end of July, beginning of August time, that sort of went sideways. But really, for 3 weeks, nothing happened in August, and then when it broke, silver, if you think about it, Mike, $28 to $35, $7. I don't know. It looks like 25% to me. I would be looking. I wouldn't risk any more than you would in gold. Really, it has some exceptionally large moves. Okay, back to the old calendar and the review. As I said, this backing and filling after a fast run up is sort of typical, really. But I think the markets are now focusing on the reality in the eurozone. So we've had this sort of euphoria where the markets were caught a little bit napping, partly some participants underweight, so the market was squeezed higher. But I think we're now really very much back on looking at the core fundamentals, and I know Germany is very much in focus. In fact, in a quarter of an hour, we've got this IFO data, which is really, really important. So please be aware, any euro-based pairs you're trading, or DAX, CAC, or Euro stocks. Germany has been this shining star for much of the last 12 months, but the sort of data that we've been looking at has suggested that even Germany is now succumbing to this sort of, I suppose you call it the turmoil, although it's less turmoil now in the peripheral countries in the Eurozone. So let's just start, as I say, we've got this German IFO climate. I'll just highlight it here. So that's literally coming out in 15 minutes. If you want to find out what it actually is, if you click on the detail bar here, and it's useful to read, the key bit is if you just read the notes here. This is a highly respected survey due to its large sample size and historic correlation with the German and wider economic conditions, Eurozone economic conditions. So, and it's a leading indicator of the economic health. The reason why we do like bits of data that are leading indicators. A leading indicator basically means it's not telling us what has happened, a bit like GDP data. You know, when we're looking at the final GDP data later on in the week from the US, that's telling us what had been produced. A leading indicator is really telling us what participants, analysts, economists, etc., researchers are suggesting is going to be happening in the future. And that tends to affect the market more, believe it or not. Okay, sorry, that's an old question. Sorry, Mike. Okay, so very useful to click on that little detail window there. In the main, analysts are a little bit divided on this IFO index because we had the ZEW last week, if you remember, which was slightly better than expected. So, there wasn't a setback there. So my suspicions are that, like we are seeing here in the forecast, we're going to get an unchanged or slightly better number, and that's what's priced in by the markets. There's a lot of data out this week, but not a lot of key core important data. So what I'm going to do is just avoid having to discuss every little bit of news because it's just not relevant and we don't have the time anyway. Okay, Tuesday, the first thing we should say, we've got Draghi speaking. Got his listed there. Well, I know he is speaking. He's the president of the ECB, speaking in a conference in Berlin. And he actually, the chances are he could well mention the ECB's bond buying program. Just remember that, the positive market reaction to the launch of this program. But obviously, a lot of it ties in with what Spain wants and has Spain, when it requests this aid. Other than that, in the US, we've got a lot of house data this week, and it's important, housing data, I should say. It's important data. We've mentioned it before. The housing market in the US has been picking up. And the first bit of data we've got is something called the Case-Shiller Composite Home House Price Index. So it's just called the S&P CS. That stands for Case-Shiller. HPI is the Home Price Index. We're expecting another rise there, 1.5%. So that'll be received fairly positively by the market. Prices have been up in each of the past 5 months, and I think there are heightened hopes raised that the recovery will have continued there. So that's a very important bit of data. Later on in Tuesday, we got the consumer confidence number. Consumer confidence, in fact, we got 2 bits of data on consumer confidence, one on Tuesday and then one on Friday in the form of the revised University of Michigan data out at, it comes out at roughly 5 to 3 on a Friday afternoon. But US consumer confidence surveys, both have shown sentiment to have waned a little bit over the last few months, certainly since earlier on in the year. And I think there's hope that there might be a little bit of an upturn now in consumer confidence. Okay, well, we said Germany was very important this week. On Wednesday, we've got German CPI. Well, we've got other bits of data in the Eurozone as well, but the German CPI. The reason why this is important is that this inflation data in Germany, it is important because it's certainly contentious, as the FT has said, for German politics, as the economy may have to stomach higher inflation due to the European Central Bank's inflationary measures to save the euro, i.e. by buying bonds in the primary and secondary market. What that does, although they will neutralize this by taking other means to take money out of the system, it potentially is inflation, and it's something that the Germans are completely paranoid about. So it could be a big political issue if inflation does tick up. So that'll be closely watched, as we can see that the expected number is flat. David King, 2 p.m. 2 p.m. 2 p.m., David. Whatever. It's coming out at 2 p.m. Thank you very much for that. Thursday, more data from Germany, I should say. So we've got German unemployment, again, a political hot potato there. I know analysts are forecasting. So for the first increase in German unemployment rate since June 2009. So that's something that's quite interesting. You wouldn't have thought that so they'd actually had... this will be the first time unemployment has risen since June 2009. Fascinating. Again, more new home sales. That's in the US, coming out on Thursday at 3 o'clock. I'm sort of jumping around a little bit, but before we've got that, we've got some core data on durable goods. Important number, durable goods, actually. It's advanced durable goods for August. Manufacturing data has been weakening just recently, so I think it'll be quite interesting to see how those durable goods come out, but we're looking at a number of plus 0.2%. Remember, all the US data will have a big effect on US dollar, any crosses that you may be trading, and the equity markets and the bond markets. So it's important to follow those US markets, those US data points quite closely. Then we have the final GDP. I mentioned to you that earlier. This is the final GDP quarter on quarter. We're not expecting any change from the last estimate or the last update at 1.7%. Remember, that's originally reported at 1.5%. It's a political issue, really, the GDP, and it's something that will be of some focus as we approach the presidential election in November. Okay, finally, Spain. There's a lot of data out on Friday, but it's not particularly important in light of all the sort of macro political events happening. We've got the Spanish bank stress tests and Madrid's proposed economic reforms, and I think this could really pave the way for this request for a bailout, or as some people are calling it, a precautionary credit line. And, the comments are that the Spanish government's decision to delay seeking a bailout doesn't seem to have backfired at all, in fact. But I think the government is treading it's a risky path, really. And I think the view is in the markets that they would be unwise to wait much longer. Jerry, I know it's a brainless thought, but as far as QE is concerned, why don't governments just print enough money to pay off the deficit? John, interesting point. Printing money, money represents wealth. If you dilute other people's wealth, first of all, it's not a good solution in the long term, but in the short term, yes, it might pay off the deficit. But of course, what it does, it increases the supply of money in circulation without accounting for it, as it were. By just printing the money, it could cause hyperinflation if you did that. The fact of the matter is, we have, the wealth was overstated in the first 5, 6, 7 years of this the last decade. We are now paying the price for that. Assets are now being repriced, and we're having to take the knock on our wealth. To then just print more money would disturb really that process, and it wouldn't achieve anything in the long run. But interesting point. As Robert Mugabe said in Zimbabwe, we're printing money. Why can't we print money? The UK government's printing money. It's just the same. But of course, it's not, because they are printing shed loads of the stuff, and that's the reason why you've got hyperinflation in Zimbabwe. But there are strict controls, obviously, over here. Like the ECB, what tends to happen is when you buy bonds and put money into circulation, of course, it is putting liquid cash into the system, but at least it's got a counter side. It's taking out those bonds from circulation, and what the ECB tends to do is they tend to sterilize their operations. So when they're buying bonds and putting money into the system, they will then drain money from the system as well, because what they don't want to do is to increase the money supply. So they will then neutralize that by conducting operations in another way that removes money from the system as well. Okay, thanks. Yes, I think this stress test will probably be fairly closely watched. But all in all, that's pretty much it for the week. Finally, I think we touched on that University of Michigan consumer sentiment number. That's also a possible market mover if you're still trading on Friday afternoon at 3:30 or 2:55. It comes out. I apologise, but we are looking for a slight. Improvement, but I noticed that revision is going to be slightly off. But anyway, that's it for now. Markets are steady. FTSE is still down 15 on the day. Euro is starting to pull back a little bit. I think this week will be very interesting. Let's see how we get on with the EFO data in the next 3 minutes. I'm just going to put you on hold. Thanks for listening. Good luck with the rest of the week.